Welcome back to our Quick Strike video series. Today is the 12th video in our new productions for the month of February. We are going to cover Vol Tools Vol by Delta page today. So as a reminder again, we just logged into Quick Strike and we're landing on our product overview page. Today we're going to work within the Euro currency and take a look at the Vol by Delta page. So let's get started. So you'll notice when you come in, some things that we'll point out again just for good measure. These option symbols are all clickable, right? So I can click on those and I'm going to get the option pop-up. And we'll cover that in a little bit more detail as we proceed through the demonstration. We also have the futures price is clickable as well, so you can see what the underlying is doing. And we also have the strike clickable as well. So you can investigate the happenings of a particular strike from a price standpoint, a spread standpoint, strike history from a volatility, all those kind of things that you've seen in the past. We do have an analysis bar here. It's a little bit simpler than the other ones. In this case, we have an expiration group filter. And what we do in the currencies, we break things down by expirations in a given year and then in weekly sections. So in this table, you'll see that both all of the expirations for this year are checked as well as the weeklies. Let's uncheck the weeklies just so we can see how that plays out. So here we go. So we have 4 less contracts in our table, and we'll leave it like that for the duration of the demonstration. We can also, from this table, we can export this to an Excel CSV file, which is nice because a lot of people do track this information in particular for the currencies. So what do we have here? So you'll notice that we have 5 delta through 45 delta on one side, then the 50 delta, and then 45 down to 5. So what we've done is we've essentially taken the March contract and interpolated synthetic strikes that will get us to an actual 5 delta, 10 delta, 15 delta, etc. So a lot of times these deltas are used to determine what a particular level is in the call and the put, and then we'll look at them from a comparison standpoint in the risk reversal and butterfly tab. So these are, we should think of them as delta-based strikes. So these are interpolated between 2 strikes that already exist or potentially land on a strike that does exist within the contract right now. But these are going to help us look at levels more consistently across, even different expirations. We could say the 15 delta put, it's a common thing that I've talked about, especially in currencies, 15 and 20 delta put or the 15 and 20 delta call to kind of get levels as to where things are trading. So we'll see all the contracts here. We got the little bit of information so you can identify them. If you need any more information, like we said, you can click on these different symbols here as well. So one, outside of seeing these values, another tab that we have here is the risk reversal and butterfly tab. So this risk reversal and butterfly tab, we're going to calculate call minus put in terms of the volatility levels. So this is going to tell us very easily when we look at this grid, it's going to tell us 15 delta risk reversal. Risk reversal is when you buy a call, sell a put. Some people say buy a put, sell a call, and we define it here. We put it in a title. It says call minus put. So what do we see by looking at this? We see that the volatility of the call is greater than the volatility of the put, and we see that in the front month. That's the case. We have small days to expiration. Typically, not typically. That occasionally happens as you move towards expiration. Some changes in the shape of the curve will occur. But you'll also notice that as we go out on the curve, that the puts at this kind of equidistant level from the at the money are a little bit more expensive than the calls because we have a negative number here. So this is a good way to see whether there's a put skew or a call skew very easily. Come in here and I know right away, positive, negative, negative, call skew, put skew. I see that right away. Over here on the butterfly side, what you see the equation call plus put divided by 2 minus the at the money. So what this is telling us, we're taking the call volatility and the put volatility and taking the average, right, dividing it by 2, and then we're subtracting the at the money volatility. So this is going to tell us, are the wings, the call and the put, the out of the monies more expensive than the at the money in terms of volatility? And in this case, we see all positive numbers, or for the most part, and we're seeing that, yes, the 15 delta portion of the curves is more expensive, net on average is more expensive than at the money. So that means we have something, a shape of the curve that looks like a smile to some extent. Okay, we see as we get closer to the at the money, 45, 40, it's not so prominent, but as we move out into this smaller delta range, we see that the wings are a little bit more expensive. Now, this is all well and good to see the number as it stands right now, but the reality is a lot of the import of this value comes from being able to see what it's done over time. So if we hover over, we're going to see these cells turn into links because you see the pointer instead of the arrow that you typically would see. So let's click on this. And what we can see is we get a chart of, in this case, we clicked on the 15 delta cell. So we get a chart that's 1 month. Right now we're defaulting to 1 month. We have 1 month of what this risk reversal has done. Okay, so if we want to go out and look a little bit further, so now we could see that there was put skew and it gradually got to where it was flat, and then there was some call skew, and now it's going back to where it was flat. So early on, before the new year, we had where the puts were a little bit more expensive than the calls. Okay, so that's some interesting information here because we could see the trend. We could see where the volatility was as well of the at the money at this time, and we could also see what the futures have done. So a lot of times this skew will correspond to a particular movement in the futures. So that's kind of the way to look at it, is to see what skew is doing. And another thing to look at when you're looking at the skew is maybe look at the put call ratio on the open interest, which we have covered already, but you can go back and kind of compare the charts. Hey, what's my skew doing versus what the put call ratio, the open interest in the call and the put are doing, so I can see whether, you know, the trade in those strikes is reflective of what the volatility is doing. And you'll notice that we have all the other deltas here as well, so I can go and look at the 25 delta. And you know, generally, when you're looking at these different tabs, what we're seeing right now is a move towards flatness or a little bit of call skew. So some good investigation can go on here as well when you're looking to see how the market's trading, you know, why certain things are getting bid the way they are, that kind of stuff. Now, to give you a better handle of how we're calculating this stuff, we have a special sheet called the OTC pricing sheet, which when we click on the symbol in this page, it defaults to this OTC sheet. So what you're seeing here is you're seeing the values that we have our 5 through 45, 50, 45 through 5. We have what those price values are. We have the volatilities like you're seeing in the table. And we also calculate some of the price values of these risk reversals, not just the volatility values of the risk reversals. So if you want to go and look at the price, you can see that here. We also show the Greeks of each of these deltas as well. But the neat thing here is that you can go and take a look. So if I go to the 15 delta, I can see what strikes we used to determine that 15 delta put. So it was, you know, 07 and 075. So really, if you have a customer or if you're looking to see, I want to put on a 15 delta risk reversal, you have an option to go in here and say, well, which strike should I use? And if you're going from a closest to this theoretical value of strikes, then you say, I might use the 075 versus down here, you're going to see, again, 18 and 18.5. So we'll probably say, I'm going to do this risk reversal. I'll buy this 18.5 call and sell this 07.5 call. So not only do you see what the delta is doing from a price standpoint and a volatility standpoint, this theoretical value is telling you theoretically what strike that is. So we were between two, so this is a theoretical between two strikes. And sometimes in the OTC market, they'll actually make a price on this particular strike. So so you have a way to compare that OTC market to what's trading in the listed market at the CME group. So this is a very helpful in order to get a good handle on what these values actually mean. So that's it for today. So again, we are on the Vol Tools, Vol by Delta. You know, I encourage you to kind of look around at the different products as well and see how these things look, and you get a good handle on sort of the shapes of the curves. And it's a real easy way to see right away whether there's put or call skew. It's a real straightforward, simple way of doing a quick analysis of the market itself. So we hope you enjoyed that video today. Today, again, is the 12th video, and we're going to continue our video a day for the rest of the month. So thanks very much.